Sweet. Let's begin.
So good afternoon. It is a pleasure to pitch a long position in XPEL Incorporated to you today. My team, including myself, Jay, is Otakar, Tom, and Shiv, and we're thankful for the opportunity. Let's begin. So XPEL is a distributor of aftermarket auto parts, primarily focusing on paint protective film, or PPF, for cars. XPEL leads the PPF market thanks to its unique product ecosystem that establishes its distribution dominance in an unpenetrated industry. Coupled with strong financials, this positions XPEL to meaningfully capture TAM and expand margins through value-accretive acquisitions. This opportunity, overlooked by the market compared to its conglomerate competitors, provides a 73% upside according to our model, which will be realized by catalysts in the near term.
XPEL primarily focuses on manufacturing paint protective film, PPF, for automobiles. PPF maintains the appearance and upkeep of a vehicle's exterior by protecting it from debris, scratches, and other forms of damage. Essentially, anyone who wants their car to look good is a potential customer of XPEL. XPEL has three main revenue streams. The first consists of PPF sales to film installation shops, who will then apply the film wrap on the end customer's automobile. This stream comprises 85% of revenue. The second revenue stream is fees from selling its proprietary software, Design Access Program, or DIPP, to film installers, who use the software to accurately cut out the desired shape of film. This comprises 6% of revenue. Finally, XPEL operates its own film installation shop, which comprises 9% of revenue.
Thanks, Shiv. So let's look into the industry. So XPEL's direct customers are mainly number one car dealerships with in-house installation services, as well as two specialized installation centers. For installers, PPF installation is a great service to sell because it is one of their highest margin businesses. For car dealerships outsourcing their installation, it is a way to drive incremental sales at little to no cost. PPF is also attractive because it targets luxury vehicle buyers. These cars have a 25% attach rate, followed by premium cars at around 12%. Attach rates amongst categories have been increasing in the past few years as car buyers started realizing that PPF provides a cost-effective way to counter car depreciation. Window tint adoption is similar, but more equally spread among car categories, as it can be considered a more essential product to some vehicle owners. Relative to the industry, XPEL has marginally better self-healing capabilities that preserve the new car look. Primarily, differentiators in the industries are value adds beyond the film product, relationships with installation stores, and brand perception amongst customers. XPEL performs very well on these aspects, demonstrated in its growth market share from 26% to 38% between 2018 and 2021. Moreover, the overall US market has grown by over 70%. That is because of many major tailwinds benefiting the industry. Number one, an increasing share of upper market vehicles that have higher PPF attach rates. Second, higher interest in PPF and window tint across more car segments, as seen in the graph below, based on data from Google Trends. Thirdly, more dealerships and OEMs preloading cars, like through XPEL's partnerships with, for example, Ruilin and Ford. And fourth, an industry reduction of volatile organic compound using car paint. These paints are better for the environment, but have lower durability, making them a prime candidate for PPF. Unmute yourself, Ota, please.
Oh, sorry. Thank you, Tom. So in a nutshell, our team believes that XPEL's product ecosystem and value-add services create significant brand loyalty that will enable XPEL to capture the market growth opportunities. The core operations cash flow can then be plowed into value-accretive acquisitions of installation centers, making XPEL a formidable long-term compounder. So delving into our first point, we see that XPEL's value proposition of combining software and film, along with value-add services, positions XPEL uniquely well in the industry. XPEL's primary differentiator is its software, with over 7 times more, which is a 7 times more comprehensive car model database than its 3M competitor. A cutting software allows for around 20% faster installation time, reduces waste by 80%, and significantly reduces the redo rate on installations, altogether presenting immense value to installers. Now, XPEL software is even better thanks to its comprehensiveness and allows for even greater cost savings on average. Comprehensiveness also prevents installers from losing out on potential revenue. Say a customer wants PPF installed on his Honda that isn't in the database. Now the installer faces a tough choice: perform the cutting process by hand, or turn the customer away. The first choice results in higher material waste, longer installation time, and higher potential of a redo. The second choice means losing out on a customer, and both will probably result in a worse referral than with using XPEL software. And XPEL has been very cleverly exploiting its software advantage. It charges no extra fees other than subscription if an installer uses XPEL's film, whereas if they use a competitor's film, they have to buy the so-called cut bank credits per square feet of film cut. And this creates a powerful incentive to carry XPEL film. Moreover, earlier this year, XPEL has contacted several dealerships that carried both XPEL and competitors and informed them to either drop the competitor or lose access to the software. From our interviews with installers, we see that the vast majority decided to go with XPEL. Thus, we believe that XPEL's software advantage provides a long-lived revenue capture edge that competitors fail to replicate. Furthermore, XPEL layers value-added services on top of its software to create long-lasting relationship with installers. It provides in-house training to installers, resulting in greater familiarity and loyalty to the product. Given low employee turnover in the industry, this is a long-term advantage that it will be hard to replicate. XPEL further bolsters the relationship with its delivery practices. It realizes that installers need timely delivery or risk losing out on customers, and XPEL is willing to absorb the costs. Delivery practices combined with training services and superior software create a powerful mix that results in brand loyalty and pricing power. As a result, over 60% of US installers carry XPEL's film, compared to only 50% carrying 3M. And XPEL can also charge around 10% more than its competitors for its film.
In order to more tangibly illustrate the competitive advantage XPEL has been able to maintain in distribution, we have to understand the value that XPEL is able to provide to film installers. This picture right here illustrates a failed PPIP installation using 3M's product, where the only defect is a few air bubbles occupying a minimal area of the car. However, this minor defect required a complete rewrap of the car using an entirely new roll of PPF. For a full car wrap, this would cost the installer around $400 in wasted material itself, in addition to roughly 5 hours of time in which they could have serviced another customer. This goes to show how even marginal superiority in cutting software accuracy, which DIPP provides over comps, is a massive value proposition for film installers. This allows XPEL to maintain distribution loyalty and pricing power to create a sustained competitive advantage over its comps.
Now, we are strongly convinced that differentiated positioning will allow XPEL to capitalize on the growth opportunity presented by the market. PPF attach rates are now in their early innings, with little over 7% of new cars sold in the US possessing some form of PPF. That sets up a long runway for adoption. We think that adoption will be driven from both the demand and supply side. On the supply side, OEMs and car dealerships are highly incentivized to drive adoption because selling PPF installation services provides a way to drive incremental high-margin sales. Our interviews demonstrate that car dealerships have begun realizing that and have been focusing on pushing PPF sales more and more. On the end customer side, we expect desire for PPF to continue increasing. The main driver will be the continuing improving perception of the product. In the past, PPF has been a lousy product. It made the car turn yellowish and had poor or non-self-healing capabilities. However, development of self-healing film by XPEL has catalyzed the 70% growth witnessed in the past 3 years. So that sort of goes on to show that right now the product is in a place where widespread adoption can be expected. Furthermore, we believe that this trend will be bolstered by further restrictions on use of car solvents in car paint, which reduces car paint durability. And also another trend that will bolster the improving perception is the increasing share of premium cars with higher attach rates. Given XPEL's near synonymousness with PPF, its strong relationships with installers, and a strong product pipeline, we think that XPEL is in a prime position to capitalize on both supply side and demand side drivers. Furthermore, thanks to management initiatives and operating leverage, we think that incremental sales will be higher margin than existing ones. In the past 5 years, revenue growth has outpaced G&A growth by 100%, and sales and marketing growth has been outpaced by 70%. Though we are conservative in our valuation assumptions, we do think that margin improvement will be a meaningful contributor to cash flow growth. A third ancillary vector of cash flow growth that we see is better inventory management thanks to continued venture into installation services. Moving closer to the customer in more and more geographical areas will allow for better understanding of customer sentiments, translating into decreasing PPF inventories as percentage of sales. Hence, we expect XPEL to convert the industry growth into free cash flow growth.
Okay, thanks, Ota. Well said. So our third thesis is that new XPEL-owned installation centers present attractive capital deployment options. This is because installation centers are high-margin businesses with low expenses, making their average return on invested capital about 30%. However, there is a shortage of skilled labor in the industry because workers need years of experience to be able to use material at hand efficiently. For example, installers need up to 10 years of experience to be able to work on luxury vehicle attachments. Due to this shortage, there are high barriers to entry, which is partially why only a few players possess most of the installation service industry market share. Therefore, XPEL can acquire installation centers for only about 4 to 6x at EBITDA. With XPEL being the owner of more installation centers, it has more direct access to the end customers, allowing XPEL to collect more data and tailor their products to exactly what the customers want. Additionally, acquisitions of more installation centers changes the power shift against dealerships that otherwise take about 10 to 15% of gross profit of installation centers. Acquisitions of installation centers allow XPEL to cut overhead costs by having a more efficient supply stream, which creates cost synergies of around 15% for an individual center acquisition and 5% for larger chain acquisitions.
Now going into the model. So incorporating these factors into our valuation, we see a 72% upside in XPEL shares at an 18.5% IRR with a 5-year investment horizon. In our bear case scenario, we see a roughly 20% downside, where we expect PPF attach rates to stay stagnant, XPEL's market share to go down by 7 percentage points, and low reinvestment of cash flows into acquisitions, given the precarious position. Here is a more granular breakdown of what drives an increase in XPEL's value. Growing adoption is the most substantial contributor, driving almost 1/3 of the increase. However, other factors, especially a shift to services and window film growth, contribute meaningfully, meaning that the company's future value is not hinging upon one assumption, but is rather driven by multiple growth vectors. Let's look at why this upside exists in terms of price dislocation. To begin with, the market misunderstands XPEL's relationship with conglomerate competitors. The current market valuation for XPEL implies that XPEL will lose market share due to concerns regarding economies of scale, an inaccurate understanding. PPF is, in fact, not driven by product specialization, enabling the superior product ecosystem to grow market share. To continue, the market doesn't recognize that rising PPF adoption is driven by the product's unique value, the bettering public perception and strategic partnerships, rather than lucky pandemic trends like changes in income. This extends industry growth runway beyond what is currently priced in. Lastly, a lack of consensus and difficulty to make price discovery, as evidenced by spread and other market activity data, cements the XPEL price opportunity.
Okay, thanks, Jay. So let's run through the catalysts. Firstly, we believe that the sustainability-driven legislation will bring more revenue to the window film segment, which helps to save about 30% of cooling costs. And actually, there's also acts by the government and subsidies, for example, the Inflation Reduction Act, which is an example of more legislation coming to help the industry. Second is an increasing pace of installation center acquisitions. XPEL voiced its interest to expand into markets like in Australia and Mexico, and it also wants more direct installation centers. And finally, we believe there will be EV deliveries outperformance. For example, maybe you knew that Tesla cut its prices by 7 to 20%, so there will be higher volume, and the EV industry is really one of the main customers because they have a lower durability on their paint. And so we think that these volume increases will spark price cuts across the entire industry.
One concern the market cites with regards to XPEL's distribution is its over-reliance on a single distributor in the Chinese market, which is responsible for roughly 18% of XPEL sales. However, recognizing this, management is actively finalizing contracts with other Chinese distributors to reduce distributor concentration to 11% in China by Q4 2022. A second concern is the notion of PPF as an undifferentiated product, where XPEL's conglomerate peers can engage in price competition to erode XPEL's market share. However, XPEL has established a sticky product ecosystem and strong brand moat, which prevents price competition, as seen by their distribution capture of the last 2 decades. Finally, the market perceives PPF as a cyclical discretionary product. However, XPEL sales have remained strong throughout economic downturns, up 20% year-on-year in 2020 and 30% year-on-year in Q3 2022, due to healthy margins for XPEL as well as its distributors, who are able to temporarily compromise on margins to maintain sales. So that's all from our end. It's been an absolute pleasure to pitch in front of you guys today. We're open to any questions at all. Thank you so much.
Thank you so much, XPEL team. And I know we introduced the judges a little bit in the introduction round, but I want to do it again. So we're here. We have Alec from Morgan Stanley Management. We have Henry from Palm Drive Capital, a venture capital company based in New York. And we have Kevin Frankfurt from Fidelity Investments. And all the judges, we're super grateful that you're here today. So the format of this, as you probably read in the email, is that the form you'll be filling out has feedback for the team, and they're allowed 15-minute presentation followed by 10 minutes of Q&A. With that being said, if any of the judges have any questions to get us started on the Q&A portion, we would love to hear from you.
Sure, I don't mind getting us started if no one else is jumping out with a question. So I see basically the two main competitors you have here, 3M and Eastman, obviously both mature companies. Both those have right around like a 12 PE versus I think right around 50 area for what we have for XPEL. How do you justify, given already around a 38% of the market for XPEL, how do you justify the current price with, I guess, future growth?
Yeah,
I can take this one. Or
Otakar, you go.
Of course, XPEL has like way higher multiples than 3M and Eastman, even though 3M and Eastman manufacture like the closest competitors to XPEL. But we don't think that really comparing them on multiples is the proper way to go, especially because 3M and Eastman are large conglomerates, and any sales from paint protection film is a drop in the bucket for them. So their resultant like P ratio or EV to EBITDA will not really be influenced by paint protection film sales that much. And now to answer your second question, how do we sort of reconcile this high valuation, or why do we think that XPEL presents a meaningful upside even then? We acknowledge that the current multiples are very high and that the entry point is not the most attractive. However, we believe in the long-term compounding power of XPEL. That's why this is a 5-year investment horizon pitch. And we fully believe that the industry is being powered by several tailwinds from multiple sides. We think that XPEL is well positioned in that industry, and we think that it has opportunities to redeploy its capital, essentially satisfying like the criteria for a long-term compounder. So that's our answer to the question.
Great, and I guess, how do you view XPEL potentially being bought out by a competitor being kind of the best route to adjust for the current price you're seeing? Do you think it would make sense for 3M to go and try to pick them up, given they have the better tech and they're obviously growing market share? Or do you think that they can basically focus on operating completely singularly going forward and still be competitive in the marketplace?
Yeah, so I think I'll take this question. I think essentially a lot of the enabling factors that have driven XPEL's growth, XPEL's market share capture, come from its specialization in the product that it's in the product that it creates. So one example of this is in terms of distribution loyalty and customer service. So Eastman and 3M have centralized customer support across all of their products, which really makes the customer consultation very effective for their PPF products. As compared to XPEL, for example, to have a very high touch customer service, the customer onboarding process is very convenient. There, they have in-house training for film installation shops when they become a customer of XPEL, as opposed to Eastman and 3M, who just outsource their training to third-party providers. They don't really have direct oversight of quality control. So essentially, all of these factors contribute together and make Eastman and 3M's product slightly slobby compared to XPEL's. Perhaps, I mean, and a lot of these factors are due to unspecialization. So we do think that for XPEL, the best way going forward is to maintain its specialization. So XPEL started off as a company that only provided the software for cutting PPF and then forward integrated into actual PPF provision. So we can see how that specialization, how that initial specialization in software allow them to create by far the most accurate and comprehensive software library out there. And we believe that XPEL's philosophy of specialization within its domain will continue to carry it forward going ahead.
Great, thanks guys.
Hey, I'm happy to hop in with a couple of questions. Thanks for doing this, guys. Really nice to meet you. Thanks for being part of the stock pitch. I guess first, can you just, sorry, you may have touched on this, but I may have missed it. What drives someone to put PPF on their car in the first place? Like, how often is it when they first buy a car? How often does it just come with it? And then how do declining car values impact that, just given what we're seeing with car prices today?
Yeah, that's a great question. So one of the main reasons why would anyone put a PPF on their cars is that it simply looks better. Most of the modern products have a higher gloss to it so that your car looks shiny and bright new basically all the time, so that you don't lose this bright new look after like 1 month. So that's one reason. The second reason is it acts sort of like an insurance, because let's say your car gets damaged by rock chips or something like that. Well, with PPF, that's no longer the case. So you won't have to repaint your car or pay for any sort of reconstruction of your car. That's the wrong word, not reconstruction, but reparation of your car. And the third reason is it preserves the value of the car for a longer time, since like the exterior look of the car is one of the largest aspects that goes into the price of a car on the used car market. Having a new car look to it will definitely improve or like result in an increased sale price on the aftermarket. So those are the three reasons. Now to your second question, it's around 7% of cars on aggregate. It's very common in luxury cars, say like Porsche, BMW, that's like 25%. Then sort of upper premium cars, like a notch below that, have around 12% based on our estimates. And then the middle category, the mid-range cars like your normal Honda or Ford pickups have around 8%. So that's around like the segmentation of the market.
And if I could add to that, we also know that about a quarter of people who buy cars are car enthusiasts. So I have a friend who loves his car more than his kids, and really like, XPEL, these are big customers, even though they don't have luxury vehicles. And really, XPEL is also penetrating into customers who don't care about their cars really that much as, for example, my friend. And it's becoming more of a norm in the industry when it's rolling out through the OEMs as well.
Got it. Okay. And then one other one for me is just, how often is it the dealer installing this versus a specialized shop? And if adoption goes to 33% in luxury cars, at some point, do the OEMs just start putting this on, and that's a risk to XPEL?
So right now, it's either like a specialized installer shop or basically a specialized installer within the dealership. It's like the dealership itself would have like in-house installation services, and XPEL doesn't really break this down. So we can't really say, but from looking at like an installer locator and running some sort of research on that, we saw that the vast majority of those installers that you can locate on their website are small installation stores, or simply installation stores dedicated to installing PPF, maybe window tint film. So it's majority that. And to your second question, we actually view OEMs preloading their cars as a catalyst, it's probably gonna take away revenues from installation stores, but it's not gonna take away revenue from paint protection film sellers like XPEL, because they'll just have a greater market to sell to. So it's a catalyst. It would definitely make the thesis about acquiring installation stores weaker, because the underlying economics of those installation stores would deteriorate slightly. But on the other hand, it would provide a huge catalyst to sales, to the extent that we think it would actually outweigh the inability to flow those cash flows back into installation stores acquisitions.
Got it. That makes sense. Thanks, guys.
I'll hop in. Hey guys, just want to say great pitch. Really enjoyed it. Like super in depth.
Thank you.
Thank you so much.
But yeah, I guess. So what's your price target versus where the securities are currently trading? Like what do you think the share price should be?
Sorry, did I understand your question correctly? Were you asking what do we think the share price should be?
That's correct.
So our target price is $118 with a 5-year investment horizon.
Okay, and what's it trading at now?
Right now it's trading at around $70, $75.
Okay, got it. That's helpful. And yeah, another question I had was on the you were assuming like a 50% growth somewhere where the market was pricing in 27.5. I'd be curious to understand the assumptions better on that.
So I think you're referring to the PPF attach rates. So if you could just hop back to thesis 2, Jay. Yeah. So
Yeah, exactly.
this is a 5-year assumption, and we've seen like the underlying trends for PPF basically double attach rates in the last 3 years, and it's been driven from many vectors. So the assumptions behind it are basically there's going to be an increase share of premium vehicles sold. Dealerships and OEMs will start preloading their cars. So just what that means is like an OEM you will order a car from, let's say, Ford, and when looking at the purchase page, you'll have a text box where it says, do you want paint protection installed? And it will be the default option. So you'll have to opt out of that, which we think is a very meaningful tailwind behind the attach rate growth. Then customers have also started realizing that PPF is getting more attractive. So the improving perception. And now I guess you are also asking about the numbers behind that. So we project that the penetration in luxury vehicles in 2028 would be 35%. So roughly 1/3 of cars compared to today's 25%. The rest of, let's say, the upper vehicle category would have penetration of 22.5% compared to today's 12%, which we think is very reasonable, because for those cars, paint protection film offers significantly greater value than the cost. And so that's one segment where paint protection film attach rates have been growing the most. And for the other segments, we project very similar growth rates to the luxury vehicles. So in the case of medium cars, we have growth from around 8% to around 14%. And in the case of lower medium cars, we see growth from around 4% to 7%.
And to further drive home that idea that it's a conservative estimate, we also haven't accounted fully for the electric vehicles that at their core are using lower quality paint due to the fact they need to save weight. And as a result, PPF almost provides a protection for this growing market of electric vehicles that are growing in volume, which will help complement that projection.
Thanks. That's really helpful. Because it just essentially it seems like a almost doubling of what the market is pricing in. So I just think it's important to have a lot of conviction on that.
Agreed.
All right. Thank you so much to XPEL team. And thank you guys for presenting this. We'll be moving on to the next team, which will be Newbank, and will consist of freshmen from Dartmouth College and the University of Madison. And I want to just say congratulations to everyone that's participated in this competition. I know it wasn't easy making it to this round specifically. We had over 500 entrants and over 110 submissions, and y'all were the top 5 freshman team. So I just wanted to say a huge round of congratulations to everyone. All right,
Thank
with
you.
that in mind,
Guys.
yeah, with that in mind, let's move on to the next pitch. And as a reminder to everyone that will be coming in, there will be 2 things. First is that let's try to keep the pitches to 15 minutes. I will raise my hand as a verbal warning. At 15 minutes, you have 1 minute to finish. And for Q&A, for participants, let's try to keep the answers a little bit shorter so we're able to move through all 5 pitches. Is everyone good to go? And for Newbank, who wants to screen share?
I will,
Right.
Ron.
All right. Well, you're co-host now.
All right, great, thank you. Okay, is everyone able to see my screen? All right, perfect. Okay, is everyone ready for us to begin? Awesome. So first of all, we just want to say thank you for spending your Saturday afternoon here with us. My name is Ram. I'm a freshman at Dartmouth. I'm pitching Newbank with my friends Aravind, Rohan, and Michael. So when we generally think of banks, we tend to think of Bank of America, Wells Fargo, maybe Chase. But what about in Latin America? Do we still think of those banks? Because for 250 million unbanked and low-income people in Latin America, those traditional expensive banks are just not an option. Today, we're pitching Newbank, which is not a traditional bank. Its disruptive low-fee credit lines and online-only presence have carved out a new market for banking in Latin America, creating an opportunity to invest in the future of banking in the developing world. There are 4 primary reasons why we see Newbank as a lucrative investment opportunity. The first is that Newbank has higher penetration across consumer demographics in Latin America than any of its competitors. They are the only bank capturing the young and low-income customers in Latin America who are projected to have the highest buying power in the next decade. Second, we project a large increase in revenue over the next 2 years that investors have overlooked. Annual revenue per active customer at Newbank is compounding by 3 times every year, resulting in 70% of Newbank's customer cohort not being represented in current revenues. Third is that its gross margins and customer base don't capture the fact that Newbank's product was built for Latin America. Its founders know the market and build the product to fit its needs, with a $5 customer acquisition cost and a 50-year lifetime value for customer. And fourth and finally is Newbank's strong unit economics and scalability that have allowed it to expand into Mexico and Colombia in just the past few years.
Going over its company overview, Newbank is a Brazilian fintech that provides banking services to Latin America. First, Newbank has experienced massive growth. The chart on the bottom left shows a 63% year-over-year growth in active customers. This has created a customer base of nearly 70 million people. Second, they've had an 87% increase in profit year on year and record-breaking revenue quarters throughout 2022. Third, Newbank's primary product is low-fee and affordable banking services, which attracts far more customers and is a key part of their business model. In fact, over 20% of Newbank's customers have never had credit cards. They are truly focused on carving out a new market. As a result, Newbank's affordable prices have made it the largest bank in South America after just 1 decade. Quickly going over Newbank's history, Newbank was founded in 2013 and their first transaction took place a year later in 2014. Since then, they have captivated the Latin American consumer. In fact, word of mouth marketing makes up over 90% of Newbank's customer growth. Seeing this growth, investors such as Sequoia Capital and Warren Buffett have poured over $650 million to facilitate Nubank's expansion into Mexico and Central America. Moreover, since 2022, Nubank has acquired various software companies, namely Juntos and Cognitech, to streamline its financial presence and build the infrastructure needed for future growth.
One of the most important things that makes Nubank successful is its low acquisition costs. We're talking about a 71% gross margin, averaged out at about $5 per customer acquisition cost. That's about an 80% organic customer acquisition rate. To put it simply, Nubank really cares about its customers, and its customers care about Nubank too. Like when a customer got scammed out of a toaster, Nubank showed up on their doorstep with a refund and a handwritten apology. What other bank would do that? That's why their net promoter score is 90%, and the lifetime value of Nubank's customers is 10 times higher than its competition. Finally, their fixed cost structure and lack of physical location caps SG&A and allows them to scale much faster than other competitors. As their customer base has expanded, their cost to serve per customer has only decreased.
Not only is Nubank growing internally, the external market is very favorable. The median age growth in Latin America is poised to hit 43, which is resulting in a customer base with higher buying power. Coupled with the fact that 65% of Latin America is unbanked, this creates a 250 million customer growth opportunity, providing tremendous TAM, or total addressable market, that feeds into revenue growth. On the contrary, large banks such as Santander have a last mover tendency and are very, very slow to innovate. Nubank has the advantage here. They have no physical locations, staff less than 5% of traditional banks like Itaú, and hold less than 1% of physical assets. Building on this, the figure to the bottom right shows that the digital banking market is projected to grow at a compound annual growth rate of 27%, which implies significant runway for expansion.
As Rohan mentioned, most of these big banks have a last mover tendency. And as a result, Nubank's rapid innovation has allowed it to outpace its competitors. The two largest growth catalysts for Nubank are its high penetration in diverse client segments and its compounding revenue per customer that we'll expand upon in our later slides. Traditional banks like Santander and Itaú Unibanco do not have these advantages with their high fees, bad user interfaces, and high cost to serve, leaving the door wide open for Nubank to capitalize on the Latin America opportunity.
Let's first focus on Nubank's diverse client composition. Here, there are three key points to address. One, geographical reach. Nubank's accessible market currently makes up 60% of Latin America's population, and Nubank is currently the largest credit issuer in Brazil, Mexico, and Colombia. Secondly, in terms of age, 59% of Nubank's customers are 35 years old or younger and will experience a real income boost of over 70% this decade. This results in larger deposits in Nubank, which in turn results in higher revenue. In contrast, only 30% of Nubank's competitive customers are in this age demographic. Thirdly, Nubank is the only large bank catered to low-income customers. They not only charge 8% less than other banks on interest for their credit cards, but pay generous rates on deposits. To sum it up, their products, services, and platform appeal to all customers and is something that other banks simply cannot replicate.
The second major growth catalyst that is moving in Nubank's favor is the compounding growth in their customer base and annual revenue per active customer. The rest of Wall Street is looking at Nubank's low-fee credit lines and its revenue per customer, and they're saying this company just won't be able to turn a profit. And the current focus on liquidity during the recession has caused investors to pull vast amounts of capital out of Nubank. But here's what they're missing. In the figure in the top right, it shows that for the first 30 months after a customer is acquired by Nubank, they generate lower than average revenue per customer. In fact, that revenue barely makes them profitable. In fact, after 10 months that a customer has joined Nubank, they start to generate over $10 in annual revenue per active customer. And what we found is that 50 million of Nubank's customers were acquired in the last few years, which means that their revenue figures are barely represented in Nubank's current revenue. Over the next few years, this population, which accounts for 70% of Nubank's total customers, is going to start generating profitable revenue. And we want to get in before that happens, because we're going to see a large increase in projected revenue when Nubank hits that mark. The chart in the bottom right shows that purchase volume by customers increases by 75% over time, showing proof that this cross-selling effect causes Nubank's customers to start to increase their revenue that Nubank collects every single year. So here's the bottom line. 50 million customers are not priced into current revenue figures because investors are overlooking the time it takes for customers to generate a profit for Nubank.
Moreover, despite the competitive landscape of banking, Nubank is optimally positioned to succeed. To understand why, there are two key relationships at play here. First, Nubank's cost and customer growth relationship. Nubank offers low credit fees and low interchange rates, which adds to its customer base. This in turn increases profits, which results in high reinvestment and further reduces costs for customers. The second relationship has to do with differentiability and brand awareness. Nubank is a leader in innovative financial services, which in turn increases brand awareness. As a result, more consumers are inclined to join, which increases revenue and further allows for investments into innovative and differentiable products. It's a perpetual cycle of growth, profit, and innovation that no other bank on the Brazilian subcontinent and Latin America can match.
Nubank is well positioned in the banking industry, giving it a multitude of competitive advantages. Nubank has been investing in many product verticals with competitive products in the past year, leading to 57 million active Nubank accounts and over 30 million active credit card user base growth. On top of that, normally switching from a competitor is expensive, but Nubank has streamlined this process, allowing consumers to switch for free, which contributes to 46% year-over-year customer growth. Lastly, Nubank has diversified, developing products such as crypto trading and investing capabilities. In fact, after just a few years, Nu Invest, which is Nubank's investing platform, is the largest digital investment platform in the entire Latin America.
So given these benefits to investing, I'm sure you're wondering what are the risks. So here's some risks that investors have expressed about Nubank. The first concerns the political situation in Brazil, which is namely that the Brazilian leftist Lula da Silva was reelected to head Brazil's development bank. Back in 2003 to 2010, this head pushed very leftist policies and prioritized public banking sectors and deprioritized private banking. However, investors overlook the fact that Brazil's development bank has set a fixed long-term interest rate and is a conservative, and there is currently a conservative majority in the Congress. The second risk would be of a recessionary cash burn, given that Nubank was not very profitable in 2022. However, as the recession has steepened, Nubank has actually increased their profits by 86% because their affordable credit lines become even more attractive during a recession. The third risk would be of a high consumer finance delinquency rate, which could hurt Nubank's brand image, given that it is relatively new in comparison to the traditional banks like Santander and Itaú Unibanco. However, given that Nubank's rate of 4.7% is 30% lower than Brazil's average, this risk is also mitigated. The final risk would be of new market entry by other affordable credit lines. But given that Nubank has already significantly outpaced traditional banks and is the largest credit card issuer in Latin America, namely Brazil, Mexico, and Colombia, it's unlikely that any competitor would be able to catch up to the large moat that Nubank has built around it. Further, adverse selection would push the riskier consumers towards these new market entrants.
So jumping into their stock chart history, we saw that they pre-IPO'd with Warren Buffett's investment of $500 million. Since then, they've been able to capture Series A through G investments totaling of about $25 billion from Sequoia, Tencent, Investico, and Whale Rock, leading up to an IPO in 2021 to about $41 billion. Now, since then, there's been a general decrease in pricing due to unprofitability. But what these charts don't show is a great revenue increase over time. Investors see that. Sequoia, Citi, Tiger Investments, and major other banks have all held big positions and continue growing their spots over time. There's been a $650 million position even offered in April 11th of 2022 as Nubank was named a Times 100 most influential company. Now, digging into their metrics a little bit more, Nubank's gross margin of 71% and low long-term debt to equity ratios position it for further growth and profitability. Another metric on this graph is its ROE ratio. I wanted to single in on this because Nubank's ROE hovers slightly below its competition, but we as a group see this as a positive. You see, by Nubank having a lower ROE ratio, they're able to decrease profitability in the short term and better serve clients in the future and have a higher profitability in the long term. Lastly, its competitive NPL ratio and 90-day default is what really sets Nubank apart in my mind, because compared to other banks, its terms of safety and its safety in this recessionary environment is truly unique and what will hold it in a good position in months to come.
Talking a little bit more about valuation, we believe that Nubank presents significant upside on an intrinsic basis. Operating revenue has been exponentially increasing, and revenue compound annual growth rate and exit projections are in line with industry averages. In fact, a 3.2 times exit multiple is in fact conservative given an industry average of 6.3 times for the fintech banking industry. Additionally, analysts have bright visions for Nubank's future, with Wolfe Research, Credit Suisse, and Goldman Sachs having price targets ranging from 34 to 150% upside. This leads to our valuation projection upside of 71.6% as a base case scenario. For this base case scenario, the long-term vision remains robust, and we envision continued growth and continued profit delivery. For a potential bear case scenario, if the risks materialize, macroeconomic trends could disrupt runway and expansion opportunities, but we still see a positive projection in this case. For a bull case scenario, we see an approximately 70% upside compared to current as cost advantages become more apparent due to a lack of physical locations, small staff, and as strategic acquisitions multiply and ARPAC appreciates significantly, cross-selling is going to play a major role in Nubank's growth.
And as Rohan mentioned, Nubank's target price and upside of 72% is not the primary reason we think Nubank is a lucrative investment opportunity, because fundamentally it comes down to this. Nubank is a rapidly growing and highly efficient company with a proven product and a huge population that's willing to bet on it. The people of Latin America have picked Nubank as their bank, and now we think that it's time for investors to do the same. Thank you. We're now open for any questions.
Hey guys, yeah, good pitch. I'm curious more about just like the revenue streams and business models and kind of margin profiles of each.
So did I understand that right? You're curious about their revenue streams and the portfolio of what exactly?
The margin profile for each revenue stream, right? So like gross margin,
right?
For interchange, credit card, yeah.
Yeah, so their overall gross margin is 71%. Most of that comes from interchange fees, which are actually lower than their competitors. But more broadly, what we're seeing is that this gross margin has been, and their revenue structure is tailored to the way the Latin American market has been working. The founders of Nubank are from Latin America, and they know how the market in Latin America works. They've specifically lowered their interchange fees to improve their customer base. And in the short term, they're prioritizing growth into new regions such that by growing their customer base, in the long run, they manage to increase revenue per customer, causing compounded revenue growth.
Got it. Thank you. Yeah, another thing I saw was, I think you use Mercado Libre as a competitor. I don't really see that because is Mercado Libre more of an e-commerce business?
Yeah, so the reason we chose Mercado Libre as a competitor was because it has many of the similar features as Nubank in terms of, as you said, e-commerce. So it's primarily focused on digital assets and this digital commerce platform in the same way that Nubank, which is a neobank, is primarily focused in the online space.
Yeah, I guess that's a fair point, but I would say it's a stretch.
Yeah, I understand that. I mean, I think the way we've approached looking at it, our competitors, is trying to find an assortment of competitors, both from digital banking, physical banking, traditional banking, and other competitors in the space that Nubank has been moving into, given that Nubank kind of tends to tread into many different areas of business in Latin America.
Another point I want to get across.
Sorry, go ahead, Michael.
No, I was saying another point I wanted to get across. Most of these competitors that we put on the list here, the thing is, Nubank is completely in a new industry. We really haven't seen neobanks jump in the position that they have recently, and we feel like there aren't very many like good comparisons. So when we mention a lot of the ones on the list, it's more of if there's other market leaders in different sectors that have also went through similar processes, whether that be that they have completely made their own industry, just as Nubank has made their own neobanking industry. We thought that was comparable in that way. So while they are in they have separate missions and they don't really compete in the same market space, we feel like they are comparable because in reality, in these Latin American markets, it's very hard to find new industries emerging just the way that Nubank has been able to make one.
Yeah, I think it'd be really interesting to hear more about how they compare to like Monzo number 26. I know they're in the European market, but there's companies that have similar product pipelines, they have similar margin profiles, similar customer bases. So I think it'd be interesting to look more into those players as well.
Good point.
Yeah, for sure.
It's a great point. Yeah.
Hey guys, thanks for doing this. I'll just ask one question. Also, I learned a lot. I didn't know that much about Nubank, so thank you. I guess on slide 14, I think it is, it's the banking metric slide. Can you talk about the NPL ratio? Like, what is it? And then you have it in green at 3.7%, and it looks like it's on the high end of peers. Why is high a good thing here?
So a non-performing loan ratio is basically the ratio of loans that go delinquent compared to total loans. So the reason we put it in green is because Nubank, as we mentioned, is a newer bank in this sector as compared to traditional banks like Itaú Unibanco and Santander, which are the second and third in the table. The reason we have it in green is because for a bank as new as NU, they're already seeing very strong NPL metrics as compared to other banks like Santander. They're already seeing competitive NPL ratios. Even though it's not the lowest in the space, that's not what we're focusing on. We're more focusing on the growth potential of Nubank as a company with low banking risk and that people have been recognizing.
Yeah, and just adding on to that point, as you can see, based on the metrics as well, since Nubank has expanded so fast, it's already taking advantage of some of the financial economies of scale that are out there. It's able to net better, it's able to diversify it better, it's able to pool better. And because of all of those aspects, its NPL ratio is already comparably next to those already large big banks. So it's that idea of, because they're expanding so fast, their economies of scale, their reputation, everything is growing accordingly. And we see no reason for that not to continue in the future.
Got it. Thanks, guys.
Thank you.
And I'll just throw a quick question out because I know we're running short on time. My question is just related to obviously the very low cost of customer acquisition at this point. You still have the company basically not being able to turn a profit. I know part of that point is that Santander and Itaú are slow moving, but as Nubank continues to grow, do you expect a lot more competition and I guess even more pressure on, I guess, the top and bottom line for Nubank?
Yeah, that's a really good question. So yeah, Rohan, do you want to start us off here?
Yeah, sure. So basically what we've been observing with Nubank specifically is that as the amount of customers increase and as the environment tends more towards recessionary, their average revenue per active customer is increasing, and the amount of customers they're acquiring in net is going up. And coupled with that, their revenue is also increasing and their profit is actually going up as well. They turned a profit for the latest quarter, I think, of over $8 million. And Ram, do you want to expand on that a little bit?
Yeah. So specifically to respond to your point about how putting pressure on their bottom line, the reason why Nubank's low customer acquisition cost and Nubank has still barely been able to turn profits is really a result of the fact that when customers first join Nubank, they're often low income consumers and they don't typically put a lot of money into the bank, which is why we see that annual revenue per active customer when they first join is very, very low compared to banks like Itaú Unibanco and Santander. And that's the reason why Nubank struggles to achieve profitability on these fledgling consumers. But what we found is that when these consumers start to hit the 29 to 33 month mark, which are the consumers that joined in 2017, 2018, they start generating very strong revenue per active customer of $8 to $10. And that's what we're looking at. We're looking at that horizon over the next 2 years, where those 50 million consumers are going to start generating that profitable ARPAC.
Yeah, and just adding on to that point a little bit more. So since Nubank has been able to expand into various different locales, their loan portfolio has become increasingly diverse. They're able to get money from a variety of different customers. They're able to pay higher explicit interest as well as offering higher implicit interest. And because of that, they're able to loan better at various different rates throughout these different locales that are established in. And going on about profitability as well, their age diversity is something that's very key to address. As you can see in this slide, as we mentioned already, like 59% of Nubank's customers are below the age of 35, which means that they're going to experience high income growth. And when they experience that once again, they can lend better, they can lend at higher interest rates. The money follows wherever there's higher interest rates. So Nubank, because of that expansion, because of that international brand, they're able to grow at a much faster pace. Right now, that growth has been very fast and they're keeping up with that infrastructure so far. But once they're able to, as you said, like realize that the revenue from active customers that haven't generated profits yet, and once they're able to expand, once these customers do become older, we see a decade where Nubank is the dominant bank in Latin America and could be potentially dominant in the global market as well.
And you mentioned a lot about competition. So I wanted to add more to your point. So while Nubank cannot hold well against like capital-wise or traditional resources that these traditional banks have, what sets Nubank apart really is it has about 20 to 30 board members that were all born and raised in Brazil and Latin America. They understand the market better than anybody. All these traditional banks coming in from Europe and America cannot compete well against banks in Latin America as they are right now, or at least Nubank that's competing in Latin America right now. So right away, I see a lot of the competition coming from America or Europe eliminated. So when it comes to competition, really the only ones that I can see would be the current banks that are institutions in Brazil or in other Latin American countries. And right now, the general population is very fed up with those banks. We've been seeing years and years and decades of high rates where customers are not able to truly get a return on their investments. They're not able to have a bank that they can rely on. And so what Nubank offers is a way for customers, is a new modern solution to that problem. This is, I think, going to be a reason why even if older banks start to lower their rates, they're going to see Nubank is going to see the most customer loyalty out of any other bank entering the area.
Yeah, just a quick thought, like looking at the net profitability of Nubank, like still burning cash from operations, right? And so I'm assuming if they soften marketing spend, is that going to impact your forecast in terms of your price target?
I can start on this, or like really quickly. I mean, 90% of their customers are actually garnered through word of mouth, and they have a very low customer acquisition cost.
I saw that too, but that's something that can still be correlated with brand, which is like a function of marketing expense. It can also be like a reflection of your product supremacy, but like, I don't know whether other people are going to enter these markets. So I think that if you're pricing it organic word of mouth growth, like at the level of 80 or 90%, it's very aggressive. I think it's like, I've seen with many companies that organic decreases over time.
That's interesting.
I can take it from here. So I feel like the difference into why they are spending a lot marketing wise right now is because the leaders in the company understand what markets they need to penetrate. So recently we saw in the World Cup that they were like the #1 leader in the marketing across the sides of the buildings. Now I completely understand that it is a higher cost, at least to what it is like conventionally to other companies. But as it is, I feel like the leaders of the companies understand how to be able to get customers because they are from Latin America. They understand that they need to capture these customers right away, and they know where to find them. So even though I think that organic, I think what initially happened
we're going to have to go to like Chile and Peru and these much smaller markets, and you're going to have to be spending a lot on awareness in those markets.
Yeah, no, I think what Nubank is really trying to do is they're trying to capture a market right now by spending a lot, and then word of mouth is the most important metric, at least in the future for Nubank. I think that they're really trying to capture the word of mouth market, whether that be family members, friends. That's what we've been able to see an increase over time. So while organic growth is slightly decreasing because of cost per customer, we've been able to see that when customers are happy about their product, which hasn't been a thing in Brazil recently, especially because of these other institutional banks, we've been able to see that they've been able to go to friends, family, and they've been able to convert them into Nubank customers. And we think that's going to expand over time as it gets into smaller areas, because Nubank is not going to try to penetrate markets that are small, like 100, 200 town markets. They're really going to try to get word of mouth as a way to expand their markets. Yeah.
Yeah. And just adding on to that point really quick. So even though we are talking about word of mouth, and even when they do expand, they might have to spend a bit more on marketing, the product speaks for itself. They offer various different financial services that other banks aren't able to. They pay higher explicit interest on everything. They offer lower interest rates on their credit cards. All of those put together, especially in unstable locations, like maybe in South America, all of those put together shows that Nubank is that bank for them. It shows that like if you come here, you're getting a higher return on your deposit, and Nubank can afford to do that because they have such a diversified loan portfolio already. They're investing in securities across various different countries as well. They're able to net better, and they're able to lower their risk as well. So with all of those things put together, the product does speak for itself. Yes, there is some marketing cost that will need to be addressed in the future because word of mouth, as you said, as companies do get larger, word of mouth might not be as effective, but it's still proving to be very effective today. And we believe that the product itself can continue to market itself for the future.
Great points. Thanks, guys.
Do we have time
All
for
right.
one more question, or should we move on?
Yeah, let's do one last question and then let's move on.
Okay, hopefully you can keep it quick. Just want to touch on if you had any data for customer retention. Obviously, it's a newer firm, so you may not, but do you have anything basically to say they can hold on to these customers that they are acquiring at the pace they are?
Yeah, definitely. So actually their lifetime value of customers is 10x their competitors. I believe it's somewhere around, I don't know the exact years, but their lifetime value per customer acquisition cost multiple is very, very high. So when they get a customer, that customer stays with them for a very long time. And their churn rate is also lower than all of their competitors at 0.13%, which yields lifetime value of approximately 50 years per customer.
Great. Thanks so much. I appreciate it.
Thank you. Yeah, thank you all so much for judging.
Thank you all.
All right. Thank you, Nubank, for coming in. The next team we have, it's from
Thanks,
UT
guys.
Austin, and they'll be pitching Jack in the Box.
Awesome. Thank you so much for having us. Could you enable screen sharing for us?
Yes. Who wants to screen share?
Me would be great, Carter.
Okay. Your co-host now.
Awesome. Thank you so much. Oh, sorry. Awesome. Okay. Okay, thank you so much for having us today. We are from the University of Texas, and we are pitching along on Jack in the Box. I'm Carter, and my teammates are Katherine, Priyanka, and Jackson.
Starting off with a company overview, Jack in the Box is an American quick service restaurant, or QSR, with a diverse and unconventional menu. Jack in the Box has two segments, their Jack in the Box segment and their Del Taco segment, which is a Mexican QSR they acquired in March 2022. Jack in the Box is highly franchised at 93%, while Del Taco is a smaller chain with 51% of their stores franchised. Both Jack in the Box and Del Taco are located in the western and southern United States. In terms of revenue, Jack in the Box receives revenue in two main ways. First, they receive 100% of revenue from company-operated restaurants, and second, they get royalties and other costs from franchised restaurants. Let's take a look at what's been happening with Jack in the Box in recent years. In 2018, Jack in the Box had a CEO who was focused on aggressive cost cutting to boost short-term earnings, leading franchisees to eventually sue Jack in the Box. However, in June 2020, a new CEO named Darren Harris was appointed. His approach includes a holistic vision for brand revitalization, and he has a proven record of success for turning around companies like CC's. As a result, Jack in the Box has launched several new initiatives to help improve Jack's brand, including acquiring Del Taco, monetizing real estate, introducing a new restaurant prototype that will reduce costs, and investing more in digital channels.
Yeah, so moving on to the industry overview, an important thing to note with Jack in the Box is that it screens poorly on a number of quantitative metrics relative to peers. So the first such metric, as shown in the graph on the left, is location growth. So while the American QSR industry has added a significant number of locations since COVID, Jack in the Box has actually lost locations for the last 4 years, ever since 2019. If same story with same store sales here. As you can tell, Jack in the Box's LTM same store sales is under 1%, whereas competitors have significantly higher same store sales growth over the last 12 months. And gross margin tells a very similar picture as well. And it's not just these metrics that Jack in the Box stacks up poorly to peers with regards to, it's also their technological capabilities. So Jack in the Box has lagged significantly behind its competitors in its major tech investments. One that I want to mention that's indicative of this larger problem is mobile web ordering. So what mobile web ordering is essentially when I wanted Jack in the Box, I can pull out my phone, go on Safari, go on Jack in the Box's website and order from there directly. Jack in the Box just rolled this out in Q4 of 2022, whereas competitors like Wendy's and Taco Bell have had this in place since 2015. So as I mentioned, that's more indicative of a larger problem, not just specifically to the mobile web ordering. And overall, these lagging tech investments mean that Jack in the Box only drives around 10% of its revenue from digital ordering, whereas its competitors and the American QSR industry as a whole typically averages around 50% of revenue coming from digital sales. And with all that said, all those numbers and the lagging tech investment is important, but the most important thing to keep in mind for the remainder of this presentation is going to be this percentage of stores franchise number. So this comp set here, which is highly franchised QSR peers, you can tell that Jack in the Box stacks up very poorly with this metric. And with the competitors being at around an average of 95% of stores franchise, and all these factors combined, and mainly and especially that percentage of stores franchise, lead to a lagging EV to EBITDA multiple relative to peers, as Jack in the Box trades at around 9x, whereas peers trade at a median of around 19x.
Here we have an annotated stock chart just to see how Jack has been trading for the past 2 years. As you can see, in November 2021, in May, August, and November of last year, the Jack in the Box stock trades closely with earnings calls and revenue misses. In December of 2021, you can see a slight drop on the day that the Del Taco acquisition was announced, reflecting negative investor sentiment regarding the acquisition. Now, in January of 2023, you can see a slight uptick in the stock, which is due to slowing wage growth. And this is a phenomenon that is reflected across the stocks of Jack in the Box peers, not just Jack in the Box.
Yeah, but to continue on with the market view, we really wanted to dive into the expectations that are being baked into the current share price. We took a perpetuity of Jack in the Box's current unlevered earnings, taking their NOPAT divided by their cost of capital, 7%, to get to about a $3.2 billion earnings power value, which is assuming no incremental investments into future growth. And you can see this is right around the current enterprise value that Jack in the Box trades at. So you can see here, there's really no growth being baked into the Jack in the Box stock. It's really being valued like an obsolete asset-intensive retailer with no growth potential and mediocre returns on capital, which is largely because of what happened under old management the last 5 years, as Priyanka mentioned. And this allows for a significant margin of safety for us. We're not arguing that Jack in the Box is a great company. We're arguing that it's an average company trading at a very cheap price.
Yeah, so moving on to our overall thesis for this pitch, we really have two main points we want to focus on. The first is that the market is overly focused on the short-term impacts of the Del Taco acquisition. And specifically, we want to point to the reduced franchise mix that Jack as an enterprise has, going from 93% before the Del Taco acquisition to currently around 84%. And the second point that we want to mention is that we believe Jack is primed for a brand revitalization in the near future. And specifically, we point towards new investments in a new store format and digital capabilities that we believe will help improve Jack's brand value to the market. In the bottom left there, we have a few catalysts. We'll get to those more in the summary slide, but I do really want to highlight why this opportunity exists. Yeah, so this opportunity exists for really three main reasons. The first is that the market is overly focused on that pro forma franchise mix number, which we believe will recover quickly than the market gives it credit for. This overfocus on this pro forma franchise mix leads to the market undervaluing and overlooking the mutually beneficial nature of this acquisition. So what I mean by that is that Jack in the Box will receive access to Del Taco's faster location growth, higher same-store sales, and importantly, access to blueprints and expertise related to Del Taco's recent store transformation, this new store format, which we'll mention later. And Del Taco, what they receive is both the internal and external expertise of Jack's franchising. And by internal expertise, I essentially mean that Jack in the Box has a significantly higher franchise rate than Del Taco. And external expertise refers to the fact that Jack hired a franchise investment bank called the Cypress Group to help quickly franchise out these Del Taco locations in 2023. The second reason why this opportunity exists is Jack's misunderstood location stagnation. And as I mentioned before, Jack in the Box has lost locations each of the last 4 years, while the industry as a whole has grown quite significantly, especially since COVID. And the market views this, and they view Jack as very low growth as a result of that. However, in 2023, we expect this to reach an inflection point. One thing that leads us to believe this is that Jack signed its first new franchisee in 10 years during the last week of 2022, and management has explicitly come out and said that they expect 2023 to be the first year of net location growth since 2019 and since Darren Harris has been appointed as CEO. And we believe that once they achieve this positive location growth, the market will value it more in line with peers in terms of its growth potential. Still not a growth stock, but a little bit higher brand value nonetheless. And the last point, which I really want to emphasize, is that Jack in the Box is being falsely anchored to past mistakes. So as Priyanka mentioned, the past CEO was pushed out because he tried an overly aggressive cost-cutting strategy. So essentially what the past CEO did is he did succeed in franchising out a large number of locations, but he was also trying to expand rapidly at the same time. And this led to an overexpansion of Jack in the Box locations. And eventually the past CEO had to cut costs across the board. And this led to an underinvestment into these brand value initiatives, leading to stagnant same-store sales from 2016 to 2019, and eventually disgruntled franchisees suing Jack. So that past failure led to Jack in the Box hiring Darren Harris in 2020, and Harris is determined not to make these same mistakes. He's taking a more personal approach by franchisees, and specifically what that means is he's focused on cutting underperforming locations rather than applying these broad cost-cutting measures across the board to all franchisees. And this strategy is a large reason why Jack has had location loss over the last few years. However, despite these initiatives by Harris, there's still speculation in the market whether or not Jack in the Box can successfully add locations while franchising out more locations. And we give Jack in the Box a lot more credit than the market apparently does.
Our first thesis is that the market is overly focused on the short-term impacts of the Del Taco acquisition. So for a quick overview of the acquisition, it was completed about 10 months ago in March of 2022 for $585 million at about $12 a share, and it was completely financed with debt. Del Taco was also bought at an EBITDA multiple of 10.6x and added about 600 locations to Jack in the Box's existing portfolio. Now, the investor reactions to this acquisition were actually pretty negative. So first, investors worried that Jack in the Box was only doing this acquisition because it had no levers left to pull and that Del Taco would pose a distraction risk to management. Second, investors also drew parallels to Qdoba, which is a Mexican food chain that Jack in the Box owned for a few years, but had minimal synergies with. Now, for potential synergies that management does foresee with Del Taco, scale and unit growth is one, like Jackson mentioned, with increasing same-store sales growth between the two restaurants. Second is supply chain advantages. And third is access to a quickly growing Mexican QSR market. Now for a deeper dive into franchise mix. Here you can see that Jack in the Box hovered around 93% franchise mix for the last few years until the Del Taco acquisition brought it down to 84%. However, management has stated that they do have plans to franchise out Del Taco locations relatively quickly. Here, there's a quote with CEO Darren Harris that says they expect the turnaround to be between 12 and 24 months. So far, 16 Del Taco locations have been sold to existing franchisees, and 120 are anticipated to sell within the next 1 to 3 years. And this is due to a partnership with the Cypress Group, which will accelerate the refranchising out of these Del Taco locations.
Yep, and now for really the rationale for why companies with higher franchise mixes trade at higher multiples. As you can see here, from 2010 to 2018, when Jack in the Box was quickly refranchising a lot of the Jack in the Box locations, their return on tangible assets substantially improved. Their operating margin went up about 20 percentage points, and their tangible assets kind of halved. So this is why there's a lot more improved efficiency, and it's much easier to grow. So mechanically, what happens when you refranchise a restaurant is Jack in the Box will get proceeds from the sale of the Del Taco restaurants to the franchisee, and then they'll get the 5% continued royalties of the gross sales. And they plan on using these proceeds to help deleverage as from the acquisition, and then return cash to shareholders through buybacks and dividends.
Now for our second thesis point, which is brand revitalization, first with improved store design. For the past few years, Jack in the Box has been seen as an obsolete brand with old stores and old food. However, Jack in the Box is now able to take advantage of Del Taco's modernization experience. In particular, Del Taco introduced their Fresh Flex prototype in 2021, which was very successful and led to 9 new franchise agreements for 68 locations in the year following. With the acquisition of Del Taco, Jack in the Box has access to Del Taco's experience, and they've been capitalizing. Jack in the Box introduced their new drive-through model in October 2022, which is expected to reduce costs by 19 to 24%. 70% of Jack's pre-pandemic sales came through drive-through, which means that Jack in the Box is targeting their most significant areas of sales. Additionally, Jack in the Box is monetizing real estate through sale leasebacks, which will help Jack become asset light and generate higher incremental returns on capital. Second, Jack in the Box is modernizing with investment into digital channels. For the last few years, Jack lagged behind competitors in terms of tech adoption. However, Jack recently introduced their digital loyalty program, mobile web ordering capabilities, and is putting digital menu boards in all new restaurants. This led Jack's digital sales to grow 32% year over year, though they still lag behind the QSR average significantly and have plenty of room to grow. We expect 2023 to be a tech inflection point. For the past couple of years, Jack in the Box has focused on developing and rolling out tech initiatives. This means that in 2023, they can leverage the data they've acquired to target more consumers.
Awesome. So now for our financials, these were the assumptions that we put into our valuation. We have the sale leaseback of Jack's real estate. So they own about 196 Jack in the Box stores that they plan to do sale leasebacks on to return cash to shareholders. So we assumed that over the next 5 years, they'd be able to do sale leasebacks for about 20 stores per year, which would generate about $30 million of yearly proceeds. And then same thing with the refranchising of the Del Taco restaurants. We assumed that they would be bought by franchisees at a 4x EV to EBITDA multiple. And we made the conservative assumption that they would only be able to do about 30 stores per year over the next 5 years of refranchising of about the 300 that are still company owned. So they'd get about $23 million of yearly proceeds from this, and then the 5% continued royalties. And the operational improvement assumptions, which are mostly based off of our second thesis point regarding the brand revitalization and the technology initiatives. We assume that Jack in the Box would be able to pick up their same store sales growth to be about 2.5% per year. We believe this to be pretty conservative. It was a bit higher than 2.5% before last year. It was about 5% and then 10% the next year, before it only being about 0% last year. And then Del Taco, we were even more conservative with our assumptions. And we assume that they would use all of the proceeds from the sale leasebacks and the franchising to return cash to shareholders. So this is our returns analysis. Our MOIC of 2.37x over a 5-year period is mostly coming from the multiple expansion driven by the refranchising and the better brand name around Jack in the Box, and then the asset sales, and then the operational improvements, which is mainly coming from our second thesis point regarding the tech initiatives and the improved brand name for Jack in the Box. So we believe this is a good risk-adjusted investment for us. And then just to conclude here, our risks and mitigants. First, with any no growth company or low growth, is management kind of overestimating their ability to deploy capital. However, we believe in the past, management has been prudent at allocating capital. They're very self-aware of the areas where Jack in the Box can expand in a value creative way, and not just overly expanding in a value destructive way. And then the second risk is macro risk, but we believe this new focus on tech and the new lower cost prototypes kind of mitigate some of the margin concerns. And we also believe that if pockets are a bit more empty from overall consumers in America, they might downgrade from the Chipotles and Shake Shacks of the world to more Jack in the Box. So even if people leave Jack in the Box, we believe there could be downsizing from other customers that could kind of mitigate the risk to sales. So this is the recap of our thesis, and then the catalysts here of Jack in the Box, the new store prototypes, the refranchising and sale leasebacks, and then the pledge for share buybacks in the future. So that's all for us today. We'll now open up the floor for questions.
Hey guys, I'm happy to kick that off. Thanks for doing this. Nice to meet you all. I actually met with the Jack management a few weeks ago as part of my job, so it's fun to see you guys pitching it. Hey, one thing that comes up a lot, I guess amongst the investing community with Jack, is in California, there's something called the FAST Act. Are you familiar with that regarding employee compensation at fast food restaurants? And just how do you think about that as a risk if you are familiar with it, given the significant footprint in California?
Yeah, so I mean, we haven't met with management, but just reading what management has put out regarding this FAST Act, what they've stated is that they typically pay a lot higher than a lot of their peers, especially those more traditional Wendy's, McDonald's type QSR restaurants. So I think the number that they gave was closer to $19 per hour, whereas their peers are paying around that 15 or 15.50 current minimum wage in California. So if these peers, or if this act passes, those peers will then have a much higher wage increase and thus a much higher price increase that they're going to try to pass along to customers. And then if Jack in the Box or if this passes, Jack in the Box can similarly apply that same pricing increase to customers, but their margin will contract or their costs will increase by less, just due to the fact that they already pay closer to that $22 an hour rate than a lot of their competitors.
Cool. I'll leave it to the others to ask questions now.
Yeah, one thing that struck me was the tech pipeline and this idea of a tech inflection point, 400% digital order growth. But how big is digital order growth as a percentage of sales? Or sorry, yeah, how big is digital orders as a percentage of sales?
Yeah, right now digital orders sits at around 10% compared to that industry average of around 50%. So certainly like they still lag significantly behind peers. But as that one graph showed on the second thesis point, they are increasing at a pretty rapid rate. That's not to say that gap's going to close this year, next year, even the year after, but they are making strides, and those initiatives do help them continue to drive customer retention and to continue cross-selling initiatives that a lot of their peers have had access to for 4 or 5 years now. So they're really modernizing quite quickly and quite effectively, but still that lagging tech initiatives and lagging tech capabilities is still persistent in this company, even though they're closing that gap.
Yeah, and I'd also like to argue on the tech portion, even though it's only 10% of revenue, I think it's more so just going to the overall trend of Jack in the Box kind of being behind competitors and kind of resulting in a declining brand. We're not arguing it's some kind of digital transformation and Jack in the Box is this growth company. We just believe this is one thing of many new initiatives that are going to help them kind of be seen at least a little bit less than peers, but not like a lot of less than peers.
And I personally don't have any questions. I think you guys did a really good job explaining how underprices looks in the current market. So well done.
Thank you so much.
Thank you.
Thank you.
Yeah, nice work, guys. Not many freshmen in college understand the whole refranchising dynamic, so that's awesome.
I appreciate it. Thank you so much.
Thank you.
All right, thank you so much, guys. I'm gonna move on to the next team. The next team will be, let's see, First Solar, made of Jason, Claire, Ruilin, and the lead from UC Berkeley. So I'm gonna turn y'all to panelists, but thank you. Hi, Lily. Can you ask the rest of your team to turn on their cameras? All right. Hey, everyone. Who will be presenting today with the screen share?
Claire, I will be, yeah.
Okay, sounds good. We're a co-host now. All right. Are the judges good to go? Sounds good. All right. Whenever y'all are ready, feel free to get started.
Okay. Hello judges. Hope you guys are doing well today. And we are very excited to be presenting our company First Solar to you guys. And my name is Jason.
I'm Claire.
I'm Ruilin.
And I'm Lily. And now I'll pass it on to Jason to get started.
Yeah, actually, I will be passing on to Ruilin to first start.
Thank you, Lily. Thank you, Jason. There are two main technologies that dominate solar PV markets, crystalline silicon and cadmium telluride. US companies are leading manufacturers of cadmium telluride and thin film technology with nearly 80% of global production capacity. Solar PV also accounts for about 3.6% of global electricity generation. The solar PV industry has three main dynamics. First, it has high barriers to entry. The industry is labor-intensive, high startup costs, and investments into capital. Secondly, the industry has heavy policies. There are many regulations and policies helping the industry to grow in US. Lastly, the industry faces internal and external competition from solar PV energy providers and other energy providers. There are three main forces driving the growth of solar PV industry. First, the global focus on green initiatives. The EU has proposed sustainability reporting guidelines and is going to channel significant funding to operational sustainability. The residential solar power installations rose by 34% from 2020 to 2021. Secondly, solar's appeal as a net zero product. It is massively appealing as a product that generates low carbon power, and the solar modules are lower in price than most alternatives. Thirdly, the huge market demand and opportunities. It is expected that solar will provide over 16% of global electricity by 2050. Going into the next slide, the solar manufacturing in the US, the market is estimated at 18 billion right now, expected to grow to around 292 billion by 2030 at a CAGR of 8.6%. Solar and wind energy in 2022 grew at the fastest rate and now accounts for 13% of nation's power generation. Looking into the solar company leaders in revenue, First Solar, Jinko Solar, and Canadian Solar are major players. Dividing up market share, First Solar accounts for 20% of the market, while the biggest player, Solar World, accounts for 23%. Now I'll pass it on to Jason to give an overview of First Solar.
Thank you, Ruilin. So now let's talk about our company selection within the attractive solar industry, First Solar. To start off, First Solar is an American manufacturer and provider of solar panels, utility scale PV power plants, and supporting services such as financing, construction, maintenance, and end-of-life panel recycling. It is the largest thin film PV solar module manufacturer globally and has both manufacturing and operating facilities in US, Asia, and Europe. First Solar is currently sitting at a market cap evaluation of $19 billion and supplies a dominating 20% of the total US domestic demand. Some of First Solar's financial highlights include a jump from a share price of $59 to $182 over the last year, which is an over 200% increase. Its gross profit margin is set at 12.4%, and its enterprise value is currently at a 7 times multiple than its revenue value. As of January 2023, First Solar is bringing in $2.5 billion in revenue, and during the second quarter of 2022, First Solar reports that it has made $629 million in net sales and obtained $1.9 billion in cash. These are just some of First Solar's amazing financial performance, and now I'm going to pass it off to Ruilin to talk about the revenue breakdown.
Thank you, Jason. First Solar's business segments include energy generation, which generated $37 million in revenue, energy generated by PV solar power systems under PPAs, which are power purchase agreements, or on an open contract. Engineering, procurement, and construction is the residential service, and the revenue is dependent on the actual cost of the construction, while revenue is also determined on contract. First Solar also provides solar modules, which generates the most revenue of $2 billion. The revenue for First Solar modules can be reduced due to transportation fees. Lastly, there's solar power system sector, which generates revenue for the sale of a development project or for the sale of a completed system, generated about $513 million in revenue. Now I will pass it on to Jason to analyze the stock of First Solar.
Thank you, Ruilin. So here, as we can see, the general trend of the stock over the last 3 years is bullish and uptrending. As depicted in the chart, there are 3 bullish periods of stocks followed by periods of correction. However, after every correction, it has always consolidated, recovered, and continued to uptrend, making higher highs and higher lows. First Solar is currently on a projected increase in share price, as depicted by the third gap. But one thing to note is that there may be a possible risk of a stock correction in the near future, just like the last 2 times. During the end of 2020, the stock took a pretty big hit due to misprojected earnings, but it has slowly recovered and achieved even higher margins after. In addition to the increasing share price every year, some of the other highlights from the past 3 years include a 37%, 31%, and 13% reduction in greenhouse gas emission, 36%, 19%, and 8% reduction in manufacturing intensity, and lastly, a 46%, 12%, and a 32% reduction in water use. All of these metrics show that First Solar is not only a profitable company, but also sustainable. Now I'm going to pass it on to Lily to speak about competitive advantages.
Thank you, Jason. There are 4 main factors that put First Solar at a more preferable position than its competitors. First, let's start by looking at their advanced technology in cadmium telluride. First Solar's products in cadmium telluride produces minimal environmental emissions and are highly effective in converting sunlight into electricity. Moving on, First Solar also runs on a proprietary production process. The process itself is highly efficient and allows First Solar to produce products more efficiently and at a lower cost than its competitors. First Solar is an industry leader in the research development industry, and their research teams are dedicated to continue developing the newest technologies. One key highlight here is that First Solar holds 2 world records for research in the areas of cell efficiency, as well as the industry in module aperture. Lastly, sustainability and innovation are the heart of First Solar. First Solar's responsibly produced PV solar modules have the lowest carbon and water footprint in the renewable energy industry, as well as the fastest energy payback time of any commercially available PV technology today. On top of that, they are also only the solar manufacturer with in-house recycling capabilities. Now I'll pass it on to Jason to talk about our first investment thesis.
Thank you, Lily. So now let's dive into the first investment thesis. First Solar is a major market player, where 84% of its net sales are generated in the United States. Even then, the US demand for solar PV is expected to increase exponentially for the next few years. This increase in demand is driven by factors such as growing electricity demand, increasing emphasis on renewable energy, and abundant solar resources. In addition, PV solar modules are also proven to be more economically favorable than traditional forms of energy generation, as they have a higher lifetime value compared to its production costs. In terms of why First Solar, it is very crucial to know that the demand for First Solar products are already high. They are completely sold out until 2026 and has double-digit GW of booking for the last few quarters. Secondly, the demand for First Solar's product will continue to increase, with both a projected increase in GW of bookings and an increase in the number of customers wanting to stay with the company until the next decade. Lastly, First Solar is incredibly well-positioned to meet an increase in domestic demand. It is currently constructing the 3rd and the 1st manufacturing facility in both United States and India, respectively. Now I'm going to hand it off to Claire to talk about the second investment thesis and the model.
Thanks, Jason. Now moving on to the second part of our investment thesis, which is First Solar's ability to localize production. As a new and growing industry, supply chain risks are one of the major factors that impact companies' performances. These risks exist because, firstly, the industry is highly globalized, and as a result, international competition largely influences domestic demand. Currently, the majority of solar panel production is concentrated in China, but countries such as Malaysia and South Korea are also becoming more prominent producers. This is especially relevant for the US, as the US is a net importer of solar PV, and domestic demand relies on its ability to import from other countries. Now, the second point is that as a growing industry, the solar panel industry receives high levels of government assistance. As a result, changing trade dynamics between countries, as well as targeted foreign policies, can put supply chains at risk of fluctuating costs. Now, First Solar is well positioned to mitigate a lot of this risk as they have manufacturing facilities across many countries, which allow them to better access domestic markets and avoid potential tariffs. First Solar also aims to source their materials for production locally at the manufacturing facility in order to reduce transportation times as well as material costs. And lastly, First Solar doesn't operate facilities in China or rely heavily on the Chinese supply chain of materials, which puts them at less risk of uncertainty in the long run. Now, moving on to our valuation for First Solar, we performed a public comparables analysis on First Solar, and we looked at 4 companies and their EV over EBITDA and EV over sales multiple. So using the following weightings on screen, we arrived at a target share price of $195.32, which represents a 16% upside from its current share price of $168.26. Now I'll be passing it on to Lily, who will talk about some risks and mitigations.
Thank you, Claire. Now let's look at First Solar's potential risks and why the company is well positioned to mitigate them. First, there is an expected increase in competition in the cadmium telluride technology industry that First Solar is making significant advances in. However, the company's notably lower carbon and water footprint, one of 2.5 times and 3 times lower, respectively, allows First Solar to stay in the lead. Moving on, with the company's ambitious plans to expand globally and at a fast pace, there comes the risk of failed investments. To mitigate these risks, First Solar can work with trade credit insurance providers who will help protect the company against financial losses by providing certainty around their cash flow. Lastly, First Solar faces a risk of relocation. The U.S. solar industry and the Biden administration have been under increasing pressure to move away from a dependence on Chinese-made goods. But for more than a decade, these products have helped the sector compete with fossil fuels like natural gas, coal, and solidify solar as a mainstream energy source. To mitigate these risks, First Solar can analyze its business capabilities and decrease the speed of overall scaling and expansion. The company can also reevaluate projects that are currently successful and further develop those initiatives. Thank you. That'll be all for our Stockbridge presentation. Thank you. And now we're going to open the floor up for Q&A.
Hey, I can get started if that's fine. I'll direct my question towards one of the pieces you spoke about, just was minimizing some of the risk from China. I know you basically argue in favor of thin film as opposed to polysilicon because it doesn't have as much reliance on essentially any shipments from Xinjiang, which has had labor issues. How do you think the consumer will weigh the lower efficiency with thin film versus polysilicon, I guess, and weighing that against potential labor issues in China?
For sure. I guess I can. Jason, do you want to go first?
No, I was just trying to understand the question, but you can go ahead.
Yeah, I thought what is really important and emphasized through our investment theses is that through thin film technology, we are less reliant on what you said, Chinese imported goods, but also looking at the thin film technology and what First Solar relies on, which is the cadmium telluride technology. It actually is more reliant for under more humid weather, more hot climate. So we thought relying on this technology, it is actually more efficient for our clients. And for First Solar, it could take the technology to more investments and potentially more customers.
Sure. I guess which regions in particular do you think it would be more efficient for? Because obviously a desert environment is where I think a lot of solar panels are currently used, just given the access to sun. The humidity won't be quite as big of a factor. So do you think First Solar will be mostly focused on particular regions with that in mind? Or do you think they can still have kind of broad appeal across multiple climates?
I'll take this question. So because First Solar's solar panels perform better in hot and humid weather, that means they're definitely more suited to target these certain geographic areas where the climate is more humid and hot. However, this doesn't stop them from having their solar panels within geographic areas that don't have the hot and humid weather, because under these weather conditions, these solar panels still perform as well as its peers. It's just only under these hot and humid conditions, they tend to perform even better than their peers, their competitors within the industry.
Thanks.
Hey, I'm happy to hop in. One question for me, just so the thesis, as I look at the slides, basically strong demand in the US and then they're localized, so they should disproportionately benefit from that. My question's really around the supply response to some of these policies that are being, I guess, put forth in the US. Like, how come a competitor won't come in and aggressively build capacity and hurt pricing? Like, what about this is defensible, and how come if you and I had $10 billion, like, we wouldn't just add a ton of supply, given we can see that what's sort of happening with demand?
I think I can take this question. So in terms of the demand already in the United States, obviously First Solar is already sold out until 2026. But the thing about First Solar is that it is currently constructing new manufacturing facilities across the globe, not even only in the United States, to provide supply to Asia countries as well, such as India. So I think that First Solar is very, very putting a lot of emphasis on producing more supplies to match its high demand in this upcoming year. And I think that versus a newly competitor that's going to come in and expect to steal a lot of the competitors or market shares, I think First Solar is already a major market player in the industry, and a lot of its consumers are staying with the company over a long time. Over the time period can vary from decades. So I think that its higher customer loyalty, as well as its increased focus in matching that demand with supply, is what's going to keep First Solar's market share and keep it a major market player in the industry. So.
Henry, do you have any other questions?
I think I should be set. Thank you.
All right. Thank you so much to the First Solar team for your effort on this pitch. And thank you for presenting.
Thanks, guys.
Up next,
Nice job.
we have a team from Cornell presenting RXO.
Hi, I'd like to be the one that screen shares.
Right. Sounds good. Give me 1 second.
Cool.
Your co-host now.
Thank you.
Hello? Hello?
Can anyone see my screen okay?
Perfect. We're just waiting for one more, I think.
Who are we expecting as the last team member?
We're expecting Pranav, but I think he's having some technical difficulties. Worst case scenario, me and Pinak can pitch this thing.
All right, sounds good. And thank you, judges, for staying over a little bit. I know this is likely going to run over in a bit, but we appreciate you for spending your time here on it for us this Saturday.
We do appreciate it. We'll get it started. I'm sure he'll get here. All right. So good afternoon, judges. And thank you, Kevin, for listening to this pitch once again. So my name is David Fang, and I'm here with my partner Pinak and Pranav, pitching RXO. We're from Cornell. We're pitching RXO at a target share price of $24.23, representing a 22% 18-month IR.
Next slide. A little bit on the agenda, the opportunity overview, describe the business. We'll talk about the truck brokerage landscape, over earning versus under earning, and sort of why does the opportunity exist and the special situation that's surrounding the equity since its most recent spinoff in late October, early November. Next slide. So we're pitching RXO at around a 22% 18-month IR, target share price $24.23. The equity closed at around $17 in its last trading day. So RXO is a very special situation opportunity with sort of providing a very attractive entry in what we believe to be a very long secular premium compounder in this fragmented space. So RXO is a very sort of best-in-class business with a lot of long-term growth runway. And we believe that it will prove to be very resilient with its very high variable cost structure during in a recession case and also out of a recession case. So a couple merits. RXO is one of the only pure play sort of truck brokerage companies offering brokerage to last mile freight forwarding and sort of providing a little bit of consulting on the side in terms of managed transportation. And obviously, lastly, its core business of truck brokerage of less than truckload. And each of these four businesses have experienced substantial 3x, 2x industry CAGR growth for the past, I think, 8 to 10 years. So secondarily, RXO is also, RXO has sort of a hidden value beneath the business in that it has a best class digital marketplace collecting about $3 billion worth of data that's collected from their truck brokerage business. And this is sort of just proving their best in class marketplace called RXO Connect, which individual trucking companies as well as large companies seeking freight forwarding capacity would use to sort of, I guess, engage in business with RXO. And last and not least, the company is able to capture sort of the company is basically a take rate business, taking sort of the difference between the bid ask of the brokerage business. And next slide, please. So a couple major sort of investment merits as to why we believe RXO will meaningfully outperform the market in the next 18 months or so is that we believe it is representing a very attractive risk reward profile with a bit more asymmetry towards the reward side of things. First of all, it generates very healthy free cash flows. It has a very high ability to convert those earnings into free cash flows. And due to the fact that it already has the best-in-class digital marketplace, CapEx is highly discretionary from this point forward, which means it opens up a lot of potential to return value to shareholders. Secondarily, which is our varying view one from the consensus, is that we believe RXO will continue to outpace the industry growth in its core brokerage business, as it has 2.5 to 3 times over in the past 10 years. And third of all, RXO represents a very asset-light model merged with sort of the best-in-class digital marketplace, which will support our merit number 4, which is sort of a best case scenario and sort of a cherry on top for this equity, which is cross-selling of services across its managed transportation, last mile freight forwarding, as well as its core brokerage business, leading to sort of a wider client base and sort of more client spend per client, basically translating to top line growth. Next slide, please. So what does the business do? RXO is one of the only pure play truck brokerage businesses in this vertical right now. It probably has the best in class technology in terms of its RXO Connect user interface, which both freight seekers and freight takers will use to engage in business with RXO. So the company serves more than 10,000 clients with no concentration problem whatsoever, and institutional 4 to 100 clients, including 250 of the top 500. So the 4 segments are broken down below, and its core brokerage business is engaging in less than truckload brokerage, which actually its original parent company XPO is a major player in. And outside of that, its secondary or the more secondary businesses include last mile managed transportation, freight forwarding, and sort of that stuff. So the equity is hovering around $17, and it has a net debt of $177 million, not in any liens or anything, but net leases. Represents the enterprise value of $1.8 billion, and the equity is just worth under $1.7 billion. So we're looking at forward multiples of, forward statistics of $4.8 billion in top line for year-end financial 22 when it comes out, and then EBITDA margin, EBITDA generation of about $300 million from that 4.8. EPS will be about 1.38, and we're looking at a forward trading ratio of 12.43. So a bit on the balance sheet of RXO. In a recessionary environment, we believe we extended our investment horizon from 12 to 18 months to sort of underwrite this recession. And let's say sort of the Fed does stick the landing with a clean balance sheet. RXO will have, I guess, what you call a fortress balance sheet. Next slide, please.
So sorry, right before I start, I just got note from Pranav that he was joined as a viewer. If it would be possible to invite him as a panelist, thanks. So yeah, moving on for
Yes,
the
of course.
Oh, thanks. So moving on for the industry as a whole. So it has been growing substantially over the past decade. As you can see on the bottom left, the broker penetration of US truckload industry has been growing at a constant 8% CAGR and is expected to grow at that rate through 2023, 2024, and 2025. And even after that, for the forward 8 years, it's expected to grow at 6.3. And for the past 9 years, it's been growing at 10%. As a result, this truck brokerage business is expected to do very well. And this will allow RXO to act as a mover with the industry as a whole. Additionally, when looking at the market share, we find that RXO is the 4th largest truck brokerage company by market share, which allows it to hold a substantial positioning within the market and also have a lot of room for growth. I'm so sorry, did someone raise their hand? Okay. So, and then in the bottom right, industry offerings by company, we find that RXO is the only company to offer all 4 main types of offerings: truck brokerage, managed transportation, last mile, and freight forwarding, whereas its main competitors, UPS, JB Hunt, CH Robinson, TQL, and Landstar, are unable to offer all of those services. As we'll note later on, major blue chip clients require a lot of these services, and that's why their contractual services with major blue chip clients is so high. And now I want to speak on the dynamics of this company as a spinoff a little bit. So the spinoff rationale was that RXO was previously a crown jewel asset hidden within XPO, and XPO is the largest provider of asset-based less than truckload transportation in North America. So realistically, there were 2 major reasons why this spinoff really occurred. The first one was there was a lack of operational synergies in capital allocation between the 2 companies. When RXO was a direct subsidiary of XPO, Drew Wilkerson, the new CEO of RXO, mentioned in an interview that the capital allocation and human resource allocation between the 2 entities was very difficult to manage, as there was not a lot of overlap that occurred. As a result, it became very difficult to allocate these inefficiencies when they were operating as a singular company. Secondary, there was a lot of institutional investor pressure to spin off XPO, as major hedge funds and stuff like that were taking small stakes, minority stakes within XPO and pressuring the board to spin off. So right now, we believe that this equity is mispriced because of a rapid selling pressure period that I'll note again in the next slide, as well as institutional investors have not been able to develop thorough reports on the equity in the business, allowing for the average investor to really capitalize on this equity. So really quickly, I want to note on the stock chart. So it opened up at 2150, and in the next 2 days, there was extremely high amount of volume that traded RXO, and the stock price fell as it was expected because of the spinoff situation, as most spinoffs typically occur. As a result, we believe that once this equity is not mispriced by the street and by the average investor, it will begin to trade on its real merits. So the real idea is that between the spinoff dynamics, that the aggregate trading price of XPO and RXO is expected to be greater than XPO stock price would have been if those two businesses had stayed together. So as for the first investment thesis that I really want to cover is that RXO has really good free cash flow conversion as well as generation. So when looking at the left chart right there, we find that free cash flow minus net transfers from XPO grew at a CAGR of 36%. So in 2020, obviously there was a dip, but we believe that this majorly happened because of a lack of supply chain synergies and stuff like that, which restricted RXO's ability to really flourish within the year. Additionally, on the right side, we find that free cash flow conversion rate, which we calculated by doing the free cash flow for that year divided by the EBITDA for that year, was an average of 60%, about 60%. When compared to C.H. Robinson, one of their major competitors, their free cash flow conversion rate is 1.2%. Now, obviously, RXO is still a budding company and has a lot of room for economies of scale. However, this drastic difference, we believe, is more attributable to the ability of RXO to really grow and scale as a business, which we will continue to cover soon. CapEx is also highly discretionary, and this allows RXO to really return a lot of value to shareholders. Now I'll pass it on to David to cover this slide.
So as previously mentioned, RXO has been meaningfully outpacing the industry's growth for many, many years. This covers sort of different periods of growth where e-commerce sort of drove the industry's entire growth. And sort of during this time span of 2019 to 2022, supported by COVID earnings, obviously, industry earnings was about industry growth was about 9% in the truck brokerage business. At the same time, RXO revenues were growing sort of almost triple that, and its EBITDA grew 40% from 2019 to 2022 with significant leverage on operations, with significant leverage on operating expenses. And we believe that to a degree, some of this operating leverage is here to stay after sort of the COVID inflated earnings. RXO's EBITDA adjusted pro forma has also doubled since 2019, which is the CAGR that I was describing. And during the same time, the truck brokerage industry's CAGR grew, not during the same time, but from 2013 to 2022, the truck brokerage industry grew by about 10%, while RXO's core business grew by a more meaningful 27%. And this trend is sort of basically the merit behind why RXO does indeed have the best-in-class sort of RXO Connect interface that provides the marketplace for freight seekers and freight takers to engage in business.
Thank you, David. So another secular growth driver that we really believe is a core part of the business is their ability to run an asset-light model as well as a very powerful digital marketplace. So in terms of proprietary technology, so we believe that RXO is able to capture volume and revenue at really low cost to serve with fewer touches. They don't operate in the less than truckload industry, so that allows RXO to really maximize their margins, and this will allow them to increase their margin expansion in the near future. So dynamic pricing algorithms driven by machine learning and artificial intelligence allow them to create really match supply and demand with between the bid spread, and that allows them to maximize their profit in the long run. In terms of sector tailwinds, we believe that there's going to be a continued outsourcing of transportation services, as we previously saw in the broker penetration of the US truckload industry. Supply side shortage of drivers and trucks will allow RXO to really capitalize on this sector. In terms of value unlock, the spinoff will unlock value over time because the spinoff dynamics naturally play out over a 2 to 6 month period. And considering that this stock was really listed on the exchanges in November, we believe that this period hasn't necessarily ended yet, but when it does, more value will be unlocked in the future. And finally, transportation services are ripe for technological disruption. So with greater than 1 million for-hire carriers, including 97% of fleets with less than 10 trucks and drivers, there's a lot of inefficiency within this market. RXO is a company that's able to really capitalize on something like this market and allow them to grow in the long term. And finally, the last investment thesis that we wanted to cover is their multitude of service lines. So their RXO industry by revenue by industry is broken up relatively well, and they have a lot of diversified clientele. They have a total of 5,000 clients, and top 20 clients make up 35% of revenue, and greater than 60% of revenue comes from clients utilizing more than one service. So additionally, their ability to be flexible between contractual versus spot revenue breakdown allows them to kind of capitalize within a pandemic or any kind of recessionary environment where they can definitely have a stable cash flow with their contractual obligations, but also not be limited to taking on new clients because of a lack of operational synergies or et cetera. So this flexibility within the business model really allows RXO to flourish in any environment and any economic climate, which we believe will allow RXO to flourish in the long run.
Yeah, and we're basically finished, but a little glimpse into the operating model. We believe that sort of the business is cyclical, but e-commerce is secular. So next slide, please. And yeah, just a summary of our recommendation. Thank you so much.
Welcome for questions.
Yeah, I'd love to talk more about operating leverage and how that has played out historically and how it's impacting your thesis.
Yeah, no, absolutely. So I believe that RXO is able to not as much as other businesses, but RXO is able to meaningfully or at least marginally improve on its current operating leverage. It carries an EBIT margin of around 4.7%, and we sort of underwrote our bear, bull, and conservative case at much meaningfully lower EBIT margins at 3.8 for the foreseeable next couple of years due to sort of the worries for recession. But we believe that in the long term, when the top line grows enough, the SG&A will be able to be leveraged against to sort of produce a better or maybe similar to COVID level EBIT margin of around just above 4%, 4.2%.
Thank you.
Yeah.
Hey guys, maybe just one for me. Can you talk about synergies or dyssynergies to the XPO spin? So like in what ways do they benefit most from being independent or standalone? And then like very related to that is XPO a major customer for them? Like is there customer concentration risk or anything like that? Or are they pretty well diversified?
Yeah, definitely. I can take this question. So as to the first part of your question, so in terms of capital allocation, RXO and XPO run on very different business models. XPO runs on the less than truckload business model, where it simply acts as a freight forwarder or a carrier of goods, whereas RXO's main benefit was the brokerage arm that they utilized with an asset light model, as well as their digital marketplace. So in terms of AI development, in terms of pricing algorithms and dynamic pricing algorithms, creating the digital marketplace and contracting out clients and really creating that benefit between the bid ask, between the suppliers and the contractors was something that XPO wasn't necessarily doing. So these two businesses were very fundamentally different, even though they acted within the same industry. And because of this, a single manager was unable to manage two different parts of RXO and XPO at the same time. Different suppliers and machinery that was used for XPO wasn't necessarily used for RXO in the same way. So as a result, it was very difficult for this capital allocation to remain efficient while both companies were part of the same overarching holding company. As for the second part of your question, no, actually XPO is not a major client. XPO is not a major client of RXO. RXO has a total of 5,000 clients, and their top 20 clients make up of 35% of their revenue. And as you can see on the left, they have very big clients like Ford, Costco, Land O'Lakes, Dollar Tree, Lowe's. And these major suppliers really make up for the majority of their revenue. So
Is XPO a major supplier or like transportation partner then?
Not necessarily. So RXO has a lot of RXO has a lot of like suppliers in terms of shippers, but they also have a lot of the clients. So XPO doesn't necessarily come in except for the initial funding between the spinoff and the restructuring costs. That's why we really adjusted for net transfers of XPO earlier when adjusting for the cash flow statement, because that was really how XPO was involved post spinoff. Additionally, I kind of want to note that more than 250 of RXO's clients are in the Fortune 500 and 58 are in the Fortune 100. So this really creates like the long-term stability with their clientele in the long run.
Got it. Thanks.
And to sort of just bolster my partner's point, the trucking industry has been like historically very fragmented and continues to be fragmented. However, we are seeing a bit more consolidation in the past decade due to the acceleration from e-commerce, and sort of these companies like RXO taking advantage of a bit more size to be able to sort of gain up on its margins a little bit more. But trucking continues to be fragmented, with most trucking capacity providers being under 10 trucks per fleet. So XPO is not necessarily a major player, even if it counts as a larger trucking company. If that makes sense. Yeah.
Any more questions from Kevin, Henry, Alec?
No.
Thank you so much for your presentation, RXO.
I'm good.
Thank you guys.
Thanks again, guys.
Yeah, thank you.